So I am going to show you something absolutely insane. If you know me, you know that I get pretty upset that in school we are taught very little about real life finances. For example, are we taught anything about FICO and our credit and how to boost it, how to maintain it? We are taught nothing. Well, the other thing we're not taught is exactly what I'm going to show you today, and that is how you can pay off a $200,000 30-year mortgage, a $30,000 car, and $12,000 worth of credit card debt in around 5 to 7 years, even if you just started that mortgage yesterday. And I'm going to show you how to do this while only making $60,000 a year and still having all your other bills you have to pay every month, okay? And I'm going to show you this absolutely free because we should have been taught this in school, and we weren't. So today, I want to pay it forward, okay? You ready? How to become completely debt-free in 5 to 7 years. Okay, this is an example of an average family across the U.S. We'll say this family is making $60,000 a year, so in other words, $5,000 a month. Okay, so $60,000, $5K a month that you bring in income. Okay, you have a $200,000 mortgage, and we have a $30,000 car, and those are or car loan, and those are what's known as amortized loans. So those loans are fixed for the most part. The monthly payments are always going to be the same. You can only put money in, you can't take money out. Okay. Over here, we have a line of credit or a credit card. Okay. $15K line of credit, $12,000 that we've already put on there. Maybe we had some tough time and all of a sudden needed to use our credit card. We have $12,000 that we've already used on our $15,000 credit card, okay? And let's say the APR, the percentage rate, the interest rate is 21%, okay? Maybe because our credit's kind of poor, maybe we have a high interest rate on our credit card. Now, let's say the house is at a 5% interest rate and the car is at 0. Maybe we hit some introductory, 5 years or 60-month 0% APR. Okay, so we're not paying any interest on the car. We're paying 5% on the mortgage. Now here, see this big circle here? That is our checking and savings accounts. And now we have our expenses, okay? So we have $5,000 coming in. We have our expenses. We have our $1,200 mortgage payment. We have our $600 monthly credit card. That's our minimum payment on our credit card to start paying down our balance. We have a $600 car payment, and then we have $1,200 for everything else. Internet, phone, cable, groceries, water, electricity, all of that. We're going to call those miscellaneous things, okay? Now, what do most families have? You have our checking account, and you have our savings account, right? So you have $5,000 coming in income, goes straight into our checking account. Now, most of us have this employee mentality. Here's what that looks like. Now, you're paid $5,000, okay? That goes where? Your checking account. And now out of that, you have your expenses. So again, $1,200 mortgage, $600 credit card, $600 car, $1,200 miscellaneous. That leaves $1,400. That all equals $3,600 in expenses, which means $1,400. What are we taught to do with that? $5,000 in, $3,600 out in expenses. Most people have the employee mentality, which is anything you have left at the end of the month, what do you do with it? You put it in savings. Right, save it for emergencies. That's what we've always been taught to do. So because of that, now you have $5,000 in and $5,000 out, which means a $0 cash flow. That's the special word that we're looking for in all of this, cash flow. That is the employee mentality, okay? The wealthy look at this very differently. They see this whole board here and they look at it very differently, okay? They look at how can I make it to where I can maximize cash flow, where I can, at the end of the month, still have positive cash flow. This is how most people live. They don't have any discretionary money at the end of the month. So we're going to shift our thinking a little bit, and we're going to create some positive cash flow. And we're going to do this by maximizing this, our line of credit. Okay? So here's what we're going to do. As soon as we get our paycheck into our checking account, as soon as we get our $5,000, we are going to transfer it over to our line of credit or credit card. Stick with me here. Now, what does that do? Because we just paid that credit card down $5,000, it takes care of that minimum payment that you had to pay this month, right? It now frees up that $600 credit card. So here's what we're going to do. We are going to cross off that $600 credit card because now we don't have that as an expense. We've taken care of that because we've put $5,000 on our card, right? We actually paid $5K, which satisfies the monthly payment, right? Now you don't have that $600 credit card. That adds $600 to your cash flow, okay? Then, here's what we're going to do next here, and you're going to think I'm crazy. We are going to not save, okay? That's right, you heard me correctly. We are going to not put that $1,400 into savings because we can maximize our strategy. Because if this money is sitting here and not over here, right? We're paying 21% over here on our line of credit. If we're not making 21% over here on our money, it doesn't make sense to keep it there. Okay, so now we have $2,000, that $600 from the credit cards, $1,400 that you would have put in your savings. You have $2,000 in positive monthly cash flow, okay? So here's what this looks like. Here's what we're going to do. Now we've got our $15,000 limit, okay? On our card, we've got our $15,000 limit, and we've got our $12,000 balance. Okay, now month one, what are we going to do? We're going to take our $5,000, put it in checking, immediately transfer it over to our line of credit, which means our $12,000 line of credit or balance just dropped to what? $7,000, okay? Because we're still paying our miscellaneous expenses, our car payment, our mortgage. What's it going to do? We're going to all of a sudden put back $3,000. $1,200 plus 6 plus 12. What is that? $3,000. We're going to pay our expenses out of our line of credit. Our line of credit, in essence, now becomes our new checking account, right? We've put $5,000 in there, lowered it to $7,000. Now we're paying our monthly expenses, and it brings it up to $10,000. Okay, now I already hear people saying, wait a second, you can't pay your mortgage and your car payment with a credit card. Guess what? You can. You can get lines of credit and or credit cards with banks to where you can make car payments and mortgage payments using your credit card. They are out there, okay? Your credit card probably will give you convenience checks, whatever credit card you have right now to use, okay? This works. That's month one, right? We've got it to $10,000. Month two, down by 5, up by 3, you're at $8,000. Down by 5, up by 3, down by 5, up by 3. What will end up happening here, it'll take about 5 months to pay off your credit card. Now, had you done it the way your bank wanted you to do it, it would have taken you 4 years, and you would have paid thousands of dollars in interest, okay? Had you just done it the way the credit card company wanted you to do it, or your bank wanted you to do it, $600 to this, it would have taken 4 years to do that. And you would have paid thousands of dollars in interest. With this way, it took you what, 6 months at the most? Probably around 5, okay? But now guess what? We have a problem. Because we're still making $2,000 worth of positive cash flow, and we have no place to put it because we've paid off our card. So we're going to do what we call chunking. We are going to chunk the mortgage, okay? We're going to pull $13,000. Let me get my pen here. We're going to pull $13,000 from our line of credit. Okay? We're going to pull $13,000 from our line of credit, rather than the 12 that we had on there before. We're going to pull $13,000, which will leave us, what's 200 minus 13? $187,000. So what we're doing is we're taking, now that we've paid off our credit card, we're going to take $13,000 off of it, which now our balance is going to go back up to $13,000, right? We're paying down the principal of our mortgage. So rather than this being at $200,000, it's now at $187,000. Now, it's actually a little bit less than that because, meanwhile, these 6 months over here that we've been paying our mortgage out of our line of credit, right? Well, part of that, we're going to talk a little bit about that in a little bit here, but part of that is our principal of our mortgage. So this is actually down a little bit. We'll talk more about that, but at least it'll be down to $187,000. Now keep in mind, what that means though is that we've got $187,000 on our mortgage, $13,000 on our line of credit. We still have $200,000 worth of debt. Okay, we still have $200,000 worth of debt. But here's what we're going to do. We're going to do exactly the same thing again that we did over here. 13,000, let's just pretend this is 13,000. Bring it down 5, that means 8. Bring it up to 11. Down 5, up 3, down 5, down up 3, down 5, up 3, etc. After about 6 months, that is going to be paid off again. Well, what are we going to do? We're going to chunk the mortgage. We're going to take another $13,000 off of our line of credit and stick it on our mortgage. Now all of a sudden, we owe $174,000 on our mortgage and $13,000 on our line of credit. Only about 10, 11, 12 months after we had started this initial routine, okay? And then we're going to do that again and again and again and again. And what happens is after about 5.5 years, this entire mortgage is paid for. It is gone. The car, the $30,000 car, is paid for because the note of the car, the loan, was 5 years. Remember, you didn't have any interest payments. It was 60 months. Excuse me, 60 months, same as cash. So over the course of those 5 years that you paid off your mortgage, guess what? You paid off your car payment as well because you've been moving your payments from your line of credit, paying your mortgage, moving your line of paying your car payment out of your line of credit. You've paid down that $30,000 car. Okay? 5 years, 5.5 years, you've paid off your mortgage, you've paid off your car payment. Okay? Well, guess what? What does that mean? You now no longer have those payments. Well, what does that mean? All of a sudden, that $2,000, now, what did we take? $1,800 more? Sorry, I'm writing sideways. So all of a sudden, that brings $1,200 and $600 for the car payment and the mortgage, for a total now of how much cash flow do you have after 5 years? Now every month you've got $3,800 worth of cash flow that you can use. Now you're sitting there thinking, wait a second. He just talked really fast and I love what I'm hearing, but what kind of black magic is this, okay? It is not. Now I'm going to write something on the board, okay? I'm going to write 5 degrees Celsius and I'm going to write 21 degrees Fahrenheit. Sorry for the sloppy handwriting. 5 degrees Celsius, 21 degrees Fahrenheit, okay? So remember those 5 and 21? We've got a 5% interest rate on our mortgage, or had it. Now we've paid it off, so we don't have it. But we had 5% interest rate on here. We had a 21% interest rate over here. Okay? And I want to just recap for a second. So 5.5 years, you've now got $200,000 in equity on your house, maybe more depending on the housing market. You have a car that's paid for. You have a credit card, a line of credit that is completely paid off, a credit card that's completely paid off, and now you've got $3,800 a month that you can use, okay? So let's go back to these numbers. 5 degrees Celsius, 21 degrees Fahrenheit. Now tell me, which one is hotter, 5 degrees Celsius or 21 degrees Fahrenheit? Why did you say that 5 degrees Celsius is hotter than 21 degrees Fahrenheit? 5 is less than 21, right? We learned that in school, at least. But something we were also taught in school is that these, Celsius and Fahrenheit, are 2 very different units of measure. Well, guess what? The banks have done the same thing. They didn't teach this, that there's a difference between amortized one-directional interest and simple interest. Amortized, one-directional interest. Simple interest, okay? Which is revolving. So what does that mean? Simple interest revolving. It means once you paid this $600, so let's say that your limit was $15,000, And let's actually say that your balance was $15,000. You've maxed out your credit card. Once you pay down $600, you're at $14,400, right? So what happens there? Why is this called simple interest revolving? It means once you paid that $600 for that month, you can go to the gas station, to the grocery store, to a restaurant, and you can swipe the card and you can then utilize that money again, okay? But once you pay over here on your loan, that is one directional. Can you utilize that money again? Can you swipe a mortgage card at the gas station or the grocery store, etc.? No. 100% of your money is gone through a loan, while only 21% of your money over here is gone in your line of credit, which means you can utilize that money again. 79% of this money in your line of credit, you can utilize. So which one is the better lending instrument, right? Okay, so let's look at the actual numbers. Even for just the first time we do this, what do the actual numbers look like? Even for just the 6-month batch, let's look at the actual numbers for how this actually did. Okay, let's say we got our $200,000 mortgage on August 1st, 2018. Okay, and here are our first 6 monthly payments. Okay, we're going to compare the two strategies. Let's compare the bank's way, which is this board here, the bank's way, the traditional route of paying your mortgage continuously for 30 years, and the smart route that we're discussing on this video, okay? So this is what the first 6 months of your amortized 30-year loan looks like. Now just a little bit of background here. In the first 10 years, first 10 to 15 years of a mortgage, that is where the banks make almost all of their money, the first 10 to 15 years of a mortgage. Why? Because even though you're paying only 5% interest, you're starting with a $200,000 balance. Right? You're starting with a $200,000 loan. So in year one, you're paying 5% of that $200,000, I should say. What is that? It's around $10,000 in the first year of only interest. Look at how much you're paying off on the principal. Check this out. First month, here's your first mortgage payment, right? You're paying around $1,073 and some change. $1,073 and some change. That's not including taxes and insurance, obviously. But $1,073 and some change on the actual interest and principal. Look at how much of that is interest. Look at how much of that is principal. Which means every single month, look at how little the balance is going down. Okay, you see that? So after 6 months of paying your mortgage, what have you paid your house down to? $198,543.06. But you've paid $4,984.90 in interest. You've only paid off $1,400, $1,456 worth of your principal. Okay, that's the traditional route. That is the traditional route. Okay, so let's look at our new smart way. What is the smart way to do this? Okay, same months. August 2018, you have your credit card that has a $15K limit. You have a $12K balance already on there. And you do your first transfer of your monthly income from your checking account to your line of credit. Okay, so month one, we added our $5,000. That brings our balance to $7,000. We pay our expenses, $3,000. That brings our balance up to $10,000. Now here's what I want to talk about. Is in that month, by doing this line of credit, okay, even if we had a $10,000 balance that entire month, which isn't going to be the case, right? Because you're not paying your expenses for the whole month on the first, or at the beginning of the month when you first pay $5,000 or put $5,000 onto the card. You're doing it over the course of the month. But let's just say, worst case scenario, you still have a $10,000 balance on your line of credit all month long. The amount of interest, even though it's 21%, the amount of interest that you're going to pay on that $10,000 is only $173 in interest. All right? Your balance is now $10,000. What do you do the following month? You put 5 in, brings your balance to 5. You pay your expenses, brings your balance to 8. You then pay your 5, balance is 3, pay your expenses, your balance is 6. November, same thing. All of a sudden your balance is 4. Now here's the issue. We're at the end of month 4, right? Well, if you can't put, if you only have $4,000 balance on your line of credit, you can't pay $5,000. You can't put your whole $5,000 check onto your credit card. You did this in 4 months, right? At the end of 4 months, you all of a sudden have your line of credit paid off. Okay? So what do? We put 4 on there. We're going to leave 1,000 in checking just temporarily. We're going to put 4 on there, pay it off to 0. So now your line of credit is down to 0, and you're going to pull out your $13,000. Okay? You're going to put that $13,000 onto the principal of your mortgage, and you're going to do that over and over and over and over again. Okay? Long story short, you guys, by doing it this way, now over those 6 months, you've made your normal monthly payments. Okay? So remember the last quarter we talked about the monthly payments, those principal payments, right? That brought your total principal owed down to $198,543, right? That was the bank way. After 6 months of paying, you now owe $198,543, okay? What did we just do? Because we're taking $13,000 from the line of credit and putting that toward the principal of the mortgage, we're going 198 minus 13. All of a sudden, we now only owe $185,543 on our mortgage. And we know we'll be able to pay that back in about 5-6 months at the most. Here we did it in about 4, right? So five months tops, you're all of a sudden paying off your credit card again, your line of credit again, putting $13,000 on your mortgage, and just doing that over and over and over and over. Now, just this first 6 months, let's just talk about this first, 5-6 months, okay? Had we done this the traditional route, do you know when we would have been down to $185,543 on the actual principal of the mortgage? When would we have actually hit this? Had we done things the traditional bank way, had we done things the way that the bank wanted us to do it, when would we have actually been at that number? 4 years and 7 months later. And in that time, we would have paid $43,457 in interest charges. Instead, total, we ended up paying $5,503 in interest, and that's including the $536 that we spent on our line of credit. That's it. Okay? We just removed almost $40,000 in interest and knocked over 4 years off of our mortgage in 4, 5, 6 months, tops. And all we did was just rerouted what account our paychecks were being put into. And we're going to do that again and again and again and again. And guess what? You keep doing this and you will have paid off your mortgage in about 5 years. You'll have paid off your car loan and you'll have paid off your credit card. You will be debt-free in about 5.5 years. How crazy is that? Okay, so here's the deal, guys. I'm not selling anything on this video or trying to pitch you, etc. I told you that. But here's what I will say. I specialize in helping insurance agents specifically figure out how to utilize this method to not only forget about just paying off your mortgage in 5 years rather than 30. That you got the information for free. Go do it on your own mortgage and show your friends and family, etc. But here's what I teach. I teach agents how to utilize this method to be able to generate instantly, like tomorrow, the most insane referral extraction machine out of your existing agency to where you can go pull all of the money that you're paying on advertising out there, all the money that you're paying on new leads and prospects, you can get rid of it because you're not going to have time for it. Okay, you're not going to have time to work leads. You are going to be getting so many referrals because I'm about to make you an expert in this. And I'm about to show you how you can utilize this video or a similar video or just this method and show people one-on-one how to do this to where you are going to be getting so many referrals. And I'm going to show you how to do all the math so that you can one-on-one with any customers Any prospects, if you want to go teach seminars, in your agency and teach your homeowners this, I don't care. Whatever you want to do with it, but I will show you what agents that we're teaching are using this method for to generate the most insane referral extraction processes in their agency, and being able to pocket and put back to their cash value every lead source that they've been paying for. The other thing that I wanted to mention is I get a lot of calls from agents wondering, well, wait a second, can I utilize the same method on my business side, on my business debt? The loans that I have on my book of business, or my credit card debt, my business book credit and things like that? Absolutely you can. Call me or contact me, and I will show you. I'll take your numbers, your specific situation, and I'll show you how to do it for yourself, so that at the very least, if a phone call with me ends up saving you hundreds of thousands of dollars, it was worth it, right? You think that's worth it? Obviously, okay? Just a phone call with me. And I'll teach you all that for free. That's how serious I am about this, okay? Here's what I want you to do to be able to get in contact with me. Let's have you do this. Let's have you send the word, let's just have you send video, 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 to my number, 206-709-6656. Again, 206-709-6656. Text me there if you would like to get in contact with me and set up a call with me to be able to show you for free, again, completely free, how to use this method for your situation, maybe your mortgage, your business debt, etc. But then also help you to see how you can use this to be able to extract referrals in your agency starting tomorrow. Okay, contact me. We'll try to set up an appointment to discuss that, okay? Again, 206-709-6656. Text the word video, and I'll get in contact with you to set up an appointment. Talk to you soon.